Which is better, SIP or lump sum? It's a question I've been asked often, and I think I've done an excellent job of disappointing people by saying both are important. And I actually stand by it because, well, look at it this way. An SIP is a tried, tested, and highly effective system of investing that ensures continuity in investments, it smoothens the cost of acquisition, and we don't have to worry about timing the markets. On the other hand, a lump sum investment is more tactical in nature that looks at market fluctuation, short-term declines, any sudden movement in the risk-reward equation, market cycles, etc. To put it differently, SIP investing gives stability to wealth creation, while investing in lump sum are like energy boosters. Point blank, both are needed, and in this video, I'll try to make a case for it with some data and numbers. Now, notice I said try to make a case. This was not accidental because when I was researching for this video, although I saw a lot of theory on people supporting the SIP plus lump sum way of wealth building, I didn't find much data on it. Actually, I didn't find any data on it. Instead, what I found was a lot of articles, videos, and comparison tables on SIP versus lump sum, which at least in my head is a non-comparison, and I'm sure most of you are beyond that stage now. In fact, the inspiration for this video came from this quick tweet by Pankaj, where he labeled an SIP plus lump sum strategy as a powerful combination for wealth building. This assertion too wasn't supported by numbers or a plan of action, but it certainly pointed to a tactical buying the dip approach, which is what I'll do in this video. Finally, I have to warn you that some parts of this video might be a little confusing and some parts might be a lot confusing because I'm trying to explain in words what's there in a worksheet, which is not easy, and therefore I'll request you to access the worksheet as well while watching this video to get a better idea of the scenarios. Let's begin. Alright, so for our study, I've used the Nifty 50 data. I used niftyindices.com, took the entire data dump from January of 2007 until December of 2023. And had I done a simple monthly SIP of 10,000 rupees, then over those 17 years, I would have invested a little over 20 lakhs and built a corpus of 61.4 lakhs at a CAGR of 11.8%, which is excluding dividends. So 11.8% is our base scenario. Now recall what Pankaj said in his tweet, a lump sum investment every time there's a 4 or 5% correction. Honestly, this is not very clear because the post doesn't tell me if this 5% drop is over a single day, a particular week, or is it from the all-time high level, etc., which means this part is for us to define. So for this study, and to keep it simple, I have assumed only Nifty 50 closing values. So I'm ignoring within the month volatility. And secondly, the correction should have happened over the next month's closing value. For example, the Nifty closed at 18,758 points in November of 2022, which was a then all-time high. The December closing was 18,105, a 3.5% fall, which did not cross our 5% correction limit. Then for January of 2023, the index at 17,662, which was almost 2.5% below its previous month's closing. So again, this number was less than 5%. And February closed at an even lower 17,300 points, which was also less than 5%. So all 3 months, the drop did not breach the 5% mark, but when one looks at it cumulatively, the Nifty did correct by 9.2% in that 3-month period. But I don't think we can do much about it. I mean, if we don't have some time boxes, some assumptions, it would be next to impossible for us to build out a system. So let's stick with those 2 assumptions and see what happens. Now, when I populated the numbers on a worksheet, what I found is that in the last 17 years, there were only 20 occasions where a lump sum investment could have been made. That is, the index had dropped by 5% over a single month only 20 times in the last 17 years. 6 of those moments came in the year 2008, while the rest were scattered sporadically, with the last such occasion occurring in March of 2020 when COVID struck. So as a strategy, it's not very practical, right? I mean, sometimes you have to wait for 1 year, 2 years, sometimes even 3 years. But just to close loop this particular simulation, if I had invested an additional lump sum of say 50,000 rupees every time there was a 5% or more monthly correction, then 50 times 20 is 10 lakh rupees. So my total amount invested would have gone up to 30 lakhs 40,000 rupees and my corpus would have swelled to over 1 crore. But what's interesting here is that in spite of inserting lump sum money during corrections, my annualized return remains at 11.8%. Now, honestly, I was expecting this number to go up to maybe 12.5%, 13%, but for it to stay at 11.8 was a big surprise. I even connected with a couple of friends who are good at math, or at least I thought so, but they were as perplexed as I was. Actually, let's spend a minute on it and examine it with a simpler example. Okay, let's assume a regular mutual fund investing strategy, and on the first day of every year, so for 4 years, I invest 10,000 rupees at the prevailing NAV. As one can see here, the NAV has been consistently increasing due to the rising markets, and as of 1st of January 2024, my XIRR stands at 18.82%. Now I'll make one change, and on the 1st of January 2020, instead of 10,000, let's say I invested 1 lakh rupees at an NAV of 10 rupees. So my first instinct was that I would see a big jump in the XIRR value, 25, 27, maybe 30%. But as it happened to me earlier, the number barely moved and the resulting value was 18.89%. So in response, I went even more aggressive, changing the 1 lakh to 10 lakhs, and yet it couldn't shake up things. Now, the only reason I could think of on why this is happening is maybe because the earliest values, the January 2020 value, has a very low weight due to the discounting function, and therefore by changing that value to even 10 lakhs was not making much of a difference, and I think that's what happened in our original scenario as well, where the annualized return remained at 11.8%. But you know what? I'm really not sure. So if any of you understands this part better on why the numbers aren't moving, then please let me know in the comments box, or if you want to send across an email or an Excel sheet along with it, then please use this email ID. Okay, so irrespective of the XIRR number, building an SIP plus lump sum strategy based on 5% monthly dips clearly won't work, because the market hasn't been presenting enough occasions for me to deploy a lump sum amount. And since March of 2020, there have been 0 trigger points. Another variation I tried is where I increased the dip percentage to 15%. So that's more of a correction, and the scenario is that a lump sum investment is made every time the Nifty goes down by 15% from its all-time high. Unfortunately, the last 10 years would have yielded just 6 investing opportunities, a couple of months in 2016 and 4 months in 2020. So clearly using a high percentage number was not working, so I tried a smaller number, a 2% monthly correction, and as expected, there were many more opportunities to invest. In fact, in the last 3 years alone, so 2021, 22 and 2023, I found 12 opportunities in my study where I could have invested a little extra in the lump sum mode. So just like in our previous simulation, in addition to the 10,000 rupee SIP, I invested an additional 50,000 rupees as lump sum investment in those 12 months where the Nifty 50 had dipped by at least 2%. The resulting data shows a definite improvement in numbers, with the annualized return jumping from 14.9% had I done a regular SIP to 16.4% when one uses an SIP plus lump sum strategy. So that's an incremental 1.5% in returns, not a small number, but since 2021 to 23 was more of a rising market, to be doubly sure, I applied the same logic for 2 more years, from January of 2018 until December 2019, when the markets were generally flat. What I discovered here was the same 1.5% differential, which shows an SIP plus lump sum strategy does have more legs as compared to an SIP only approach. But when I was doing all this excelling, a few issues did prop up. Like in my case, I assumed an unlimited supply of lump sum money, which is practically not the case. For instance, in 36 months, that is from January 21 until December of 2023, I simulated 12 lump sum investments of 50,000 rupees each, so 6 lakh rupees, while the SIP investment during the same time period was just 3.6 lakhs. This is clearly not realistic, and so I added a second layer of limitation and assumed that there was only 1 lakh rupees of lump sum available each year for me to invest. Now, because an investor doesn't know how many lump sum investment opportunities would be available every year and in which month, I enforced another condition that I could invest only 50,000 rupees in each half of the year on the first available lump sum opportunity. For example, let's say the first lump sum opportunity, that is a 2% dip in the index, comes in the month of February. So I'll go ahead and invest 50,000 rupees in that month. Now let's say the next opportunity comes in May of the same year, but because I have that once in every half of the year restriction, I can't invest in May. Then again, if the opportunity shows up in October, then I can invest, and if the opportunity had not come in, then that 50,000 remains unutilized. I'm sure this part is getting confusing now, and perhaps now you and I can understand why there isn't much data-backed literature on this SIP plus lump sum strategy. And I think it's because this lump sum strategy can be played in hundreds of different ways. I could have carry forwarded the lump sum amount, I could have broken it up on a per quarter basis. I could have used a 3% dip or a 4% dip or a 6% dip. The frequency could have been changed to weekly, fortnightly, or even daily movement of the index, etc. Anyways, to keep it simple and to get at least one simulation in place, I settled for a 50,000 rupee lump sum insertion on the first available opportunity every 6 months. Upon applying this condition in our simulation over a 3-year period, and to my surprise, I was able to deploy the 50,000 rupee lump sum in each of the 6 half years, giving me an annualized return of 15.4%. I also applied the simulation over the entire 17-year period, and sure enough, an SIP plus lump sum strategy was able to improve my investment to wealth ratio, although I could not get that reflected in the XIRR number in my Excel worksheet, so any help in this regards will be truly appreciated. Okay, so this was a lot of numbers, a lot of conditions, confusion. So to quickly recap the process, number 1, set up your SIPs preferably on the first or the first week of every month. Secondly, divide your lump sum money into 2 or more chunks, like the 50-50 I did with a lakh of rupees for each half of the year. Then set up the condition for deploying the lump sum. Again, this can be a 2%, a 5%, or if you're into moving averages, then you can look at that as well, but have a system, a condition in place. Step 4 is to set up alerts, which are available in many screening portals and brokerage platforms. And that's it. Implement the SIP plus lump sum method on the respective trigger dates. I think what will really help here is if you try to do the simulation by yourself on a worksheet, because I think that will give you a more profound understanding of this method. And once you've done a few customizations, I think you'll also start seeing the benefits of this approach. I do hope and pray that I haven't confused you enough. And if you find a better way of deploying an SIP plus lump sum strategy, then please share it with me along with the data, assumptions, and limitations. Once again, thank you for your time. Do subscribe to my newsletter, and I'll see you very soon. Until then.